welcome everyone to this presentation on the foundation of systematic trading. I'm Duran Whitman, the founder of the Algorithmic Trader Association. I just want to do a quick sound check to make sure everyone can hear me. Very good, so we can get started. So welcome again everyone, and thank you for your time. I hope you enjoyed this presentation by Alex Christop. Alex, please go ahead.
Thanks, Doran. Good afternoon or good morning, everyone, and welcome to the continued educational webinar series by Algorithmic Traders Association. My name is Alex Christop. I am the Director of Educational Programs with Algorithmic Traders Association. In this webinar, we will discuss the foundation of systematic trading, the logical basis on which it is based. Systematic trading is a relatively new term. It first appeared around the middle of the 20th century along with the development of technical analysis and was opposed both to discretionary trading and investment in general because investment assumed holding assets for a long period of time and trading was mostly associated with something of short-term nature. Let's start with the most common beliefs about systematic trading and see which of them are realistic. Systematic trading is mostly confused today with algorithmic trading, which in turn is associated with very complex mathematical models. However, systematic trading is not only about mathematics. Its main strength is in logic and discipline. In order to make all the following discussion more substantial, we need to provide a definition of systematic trading. I think that the most correct definition would be like this. Systematic trading is a trading method where all trades are initiated and liquidated according to a predefined set of rules, which in turn are based on preliminary analysis of available historical market data. Note that historical is very important here, as discretionary traders also analyze market data, but mostly only those that are available at the moment. Systematic trading may work only when the set of rules which initiate and liquidate trades is appropriate to the particular market. This means that these rules should describe processes that happen in this market and these processes, in turn, should be repeating. But where is the guarantee that these processes and consequently the trading rules can be found? Aren't markets so changing and so unpredictable that any attempt to create a rule-based trading system are doomed from the very beginning? I think you are familiar with such an opinion because it is very popular. In order to answer this question, let's go back to the discussion about the model of a market as a superposition of humans and their actions. We discussed it in one of the previous webinars, and those who missed it can watch the recording in our YouTube channel. The key point in this model is that many of these actions are repeating. Sometimes such a repetitive action, also known as pattern, can be even visually observed in price charts. Although I'd like to note that most of truly tradable and profitable patterns are very hard to discern just visually. As you can see now, this nature of the market gives birth also to well-known technical analysis, a technique which mostly analyzes chart patterns. Double tops, double bottoms, triangles, head and shoulders, they all are just visual traces of certain repeating market processes, and therefore, theoretically, they can be exploited. However, systematic trading is not just technical analysis, because technical analysis is only focused on determining a certain pattern, but it seldom tells the trader what exactly to do when he sees such a pattern. If you read any book on technical analysis, you might have noticed that most of them explain in most detail how to enter the market, but only a very few of them suggest how to exit it. Moreover, all rules suggested in those books on technical analysis are very vague and often ambiguous. Indeed, how could we actually follow a rule, for example, to exit with a profit of 100 to 200 points? Should we exit with a profit of 100, or 150, of 200? On what does it depend when to actually exit? In contrast, a true trading system always contains understandable and unambiguous rules which leave no room for human discretion. They may be as simple as just exit with a profit of 100 points, or complex like exit with a profit of no less than 100 points when the position is held no less than 5 days and the new high is not refreshed in 6 hours. But in any case, such a rule is easy to follow. You only need to be careful and do exactly what is suggested by the rule. Well, this sounds very natural, and you might ask why not everyone trades this way. Indeed, it seems like an easy way to trade. You only find a number of repeating patterns, create a set of rules, and follow them. First, a lot of people simply don't believe in systematic trading. Systematic trading is not Holy Grail, nothing even close to it. Series of successful trades are always interleaved with unsuccessful ones, and the trader has to be very convinced in the correctness of his observations about the market and consequently in the solidity of his trading system to go on following the rules in a drawdown. Second, even more people are clueless about where even to start looking for systematic trading ideas. I agree, this is a very serious obstacle. Most often, novice systematic traders try to copy existing technical analysis patterns and trade them systematically. However, I hope you remember what technical analysis lacks. And without precise, unambiguous trading rules, no systematic trading is possible. Such a trader will have to always add some discretion to actually enter and exit a trade, and therefore there is no system in his trading anymore. And last but not the least, many traders are heavily biased by numerous success stories. I'm sure you heard many of them about famous traders of the past who made millions during the Great Depression, who converted $1,000 into $1 million in a year trading commodity futures, and many more. These stories are so frequently quoted here and there that novice traders often think that this should be their ultimate goal in life. Needless to say that almost 100% of them never reach this goal. But let's try now to think why. Note that all success stories of this kind are about discretionary traders with no exceptions. You will never find a success story like this, about a systematic trader. This fact is also frequently used to support the idea that only discretionary trading can be successful. Is this really true? Let's look at what a discretionary trader does. A discretionary trader always looks for opportunities, anything that, in his opinion, may bring him profit. When a discretionary trader is able to identify a trading opportunity, he trades it, regardless of the motivation of this opportunity. Sounds good, but the problem is that the motivation of these opportunities is different every time. Here, we approach the main difference between discretionary and systematic trading. If we trade discretionarily, we cannot estimate our risk, upside potential, anything. Why? Because every time the situation is different. Today, a discretionary trader trades because he heard something in the news, tomorrow because a fellow trader told him something, and next week because he just thinks that he needs more money and therefore increases the exposure. He just thinks that there is an opportunity and trades it. None of these actions can be anticipated, not to say predicted. As it can be anticipated, we can't calculate any statistics of trades. We cannot assess risks and suggest a proper money management. Thus, a discretionary trader may win big once, but may lose everything in the following series of trades. With systematic trading, the cornerstone is careful risk management, which allows to survive even in a long series of losing trades, and it can be based only on proper assessment of risks. Such an assessment can be based only on statistical analysis, and statistical analysis can be done because all trades are done according to a single rule and are therefore allowed to be analyzed. A systematic trader will even miss a trade which might look a definite win, but which cannot be explained by his model. Why? Because he has never tested it. He doesn't know what happens next time he sees such an opportunity. If any of you has ever tried to trade, I guess you are well familiar with the temptation to place a certain trade just because you feel like it. And I'm sure that many times you regretted that you hadn't placed such a trade. But have you ever carefully calculated statistics of these emotional trades? How many of them did actually result in a profit, and how many of them ended with a loss? Thus, the foundation of systematic trading is proper risk management based on thorough statistical analysis. Now we can easily understand why all famous traders of the past were discretionary traders. Only a discretionary trader can ignore all reasonable money management and risk management and enter the market with all funds at his disposal, and sometimes even with a leverage. As the result, sometimes, very seldom to be honest, a discretionary trader makes millions out of almost nothing. It's another story that 99% of discretionary traders lose money, but no one will ever recall them. That's how success stories appear. Give them some time and you can see legends. Now let's go back to systematic traders. They could have made millions, and the percent of successful and consistently successful systematic traders is way greater than that of discretionary traders, but will remain unknown, at least for wider audience. Indeed, what is so much exciting about guys that systematically make small profits? Their stories are not interesting for newspapers. You can't find a single story about a systematic trader that got rich in a month or even a year. So, a systematic trader can become famous only with a very, very long positive track record. This is the only thing that may attract the attention of the general public. Only dinosaurs of systematic trading like Renaissance technology sometimes are spotlighted by media, and mostly by professional media. So the choice is yours to go for a chance to become a new Jess Livermore, and don't forget that your chances to be just yet another unknown failed trader are way greater. And then hope is of course your guide. Your edge in this case will be your luck. Otherwise, you can go for small but consistent and systematic profits. Wend your way through ever-changing markets and make your fortune with hard work. Your edge in this case is a solid statistical analysis. For those that want to follow the discretionary way, I can only say thank you for your attention. And for those that want to pursue success in systematic trading, I would like to say a few words about our exclusive educational course in systematic trading, where you are taught not only to develop trading systems, but also to find new trading ideas based on exhaustive market research. The course consists basically of 3 stages. The first one is dedicated completely and totally to market analysis. The second one works with the algorithm design, with backtesting and optimization. And the third stage is all about portfolio design and risk management. Within the first stage, we work with a very special analysis of market. We consider markets from a standpoint that assumes that the market is a superposition of humans and of human actions. This model allows us to identify new ideas that work in this particular market. And since we are able to spot reasonable and logical trading ideas, we're able then to convert these ideas into algorithms and working programming codes. Then comes the second stage, when we need to analyze our system, to run backtests, and of course we discuss how to do that properly, how to make sure that the statistical significance of our backtesting data is always maintained, and that backtesting definitely represents something reasonable and not just curve fitting. If you want to learn more about the premises of backtesting, you can always refer to one of the previously recorded webinars dedicated to backtesting that you can find in our YouTube channel. Also, we work with optimization, and we consider optimization as a research tool rather than just a method to find a unique single set of parameters which delivers the best performance, otherwise known as curve fitting. And within the third stage, we discuss perhaps the matters of the highest level, about how to create robust portfolios, how to manage operational and systemic risks. This is a very important thing. And as a part of that, how to identify the moment to switch off a system. Because sometimes, unfortunately, this is the only reasonable solution that you can offer. This educational course normally takes about 3 months. It consists of weekly live online classes, but between these weekly live online classes, there is plenty of work because every student gets an assignment, and each assignment assumes really hard personal work. Well, you can consider yourself as studying at a university. We work in very small groups, which never exceed 3 students, to make this education more efficient, because students come with different backgrounds, with different level of expertise. Therefore, we do our best to combine them in groups that are more or less similar starting level. Some basic mathematical background is always required, of course, because you need at least to understand what the basic statistical terms mean. And some basic programming skills are also required. This means that at least you need to understand what is programming, what is a programming language, what is a variable, what is an if-then-else operator. So very, very basic things. Of course, some experience with programming is always a plus. And since all examples that we consider during the course are provided in easy language, Of course, experience with trade session or multi-threads is also a plus, but again, it is not mandatory. So now I would like to thank you again for your attention. And in case you need more information about our educational program and certification, please feel free to write to info@atissn.com. You can also do that by filling up the form at the classes page of the site. And now I'm ready to answer questions. The first one is, how much trading experience do you need to start this course? Well, I would say that trading experience is not required to start this course. Sometimes trading experience is a very bad helper, because your experience may introduce some bias in your decision-making process. And therefore, you need only to be familiar with the basics of the market terminology, so that we don't need to explain you what is a futures contract, what is expiration, what is an exchange, what is an ECN, and so on. So only the basics, perhaps. Is your framework methodology universal, and can it be applied to any tradable market, for example, Asian indices? Yes, I think that this methodology is universal and can be applied to any liquid market. So if you mean liquid by tradable, then yes, I think this is universal. On the other hand, I should make a disclaimer that personally I am proficient mostly in index futures, in commodity futures, and spot forex currencies. Therefore, I can only make a very reasonable hypothesis about the applicability of this method to other liquid markets, but again, the reasons why this method works for the mentioned markets make me think that it should work for others. Can you suggest any common criteria to evaluate the performance and to compare it to different algo systems? Well, of course I can, but this will be a subject for one of the upcoming webinars, so I would prefer not to spend time on it right now. I'm trying to understand what to expect when I finish the course. Will I have real working strategies that were tested in the class? Yes, we do consider a number of strategies which are not only back-tested and tested with simulated trading, but they are also tested in live trading. I would even rather say that you are not provided with these systems, but you are provided with ideas, and then you develop the final systems out of this idea under my guidance. To give an idea of what it looks like, normally we start with a very simple system for S&P 500 E-mini, and the core of this system can be written in easy language in just 3 lines of code, literally 3 lines of code. But when you start to account for minor but important nuances, the final result varies from 82. One of the students showed me a code that consisted of 211 lines. But the core idea in each case was the same. So the thing is that not only you are provided with some working trading systems, you learn how to develop them themselves, yourself. What are the differences between systematic trading and algorithmic trading? Algorithmic trading is a subset of systematic trading, if you want. This is a term that normally is applied only to a very narrow niche of trading applications that work mostly with executing very large trading sizes. That is, for example, you need to buy 100,000 shares of a certain company. If you just go to the exchange with such an order, most likely the exchange will just reject this order because you will simply consume the total liquidity that is available at the moment. Therefore, such an order normally requires an execution algorithm that executes this ordering portions. This is what the algo trading was known originally. As time went, this term algo trading somehow deviated to first describe all activity that is, let's say, high frequency market making and similar things. And today, algo trading is very often used as a synonym for systematic trading. For more information, you can refer again to one of the previous webinars, if I'm not mistaken, the very first webinar in our series, where I explained all these nuances of terminology. When you interpret data, how do you make sure your interpretation is not subjective and was quantified objectively? Well, unfortunately, there is nothing that is objective in the market, simply because, remember, the market is a superposition of humans and of human actions. Therefore, everything in the market is subjective. Do you test potential students on their basic modeling programming skills? Do you have refresher courses on the two? No, we don't have any refresher courses. I wouldn't say that I test anyone, but I always do have an interview just to make sure that even if you don't have sufficient skills, whether it will be possible to quickly get you to this level. Just to provide you with an example, right now I'm working with a group of students where neither of them had any experience in programming, but after I had an interview with each of them, I understood that it would be relatively easy to get them to the required level, and I'm happy to say that it took only a week of work for each of them. Now they are able to create codes that are complex enough to describe the trading ideas that we're working with. Are arbitrage strategies part of this course? Not directly. We are not focused on arbitrage strategies during the part where we actually work with codes, but we do consider them along with many other trading styles because sure, we have to understand what goes on in the market and which types of trading strategies exist out there, simply to understand how the followers of certain approaches to trading affect the market and therefore how they can be exploited. If you do deploy capital in a systematic trading system currently, not sure if I understood the essence of your question properly. Do you deploy capital in systematic trading system currently? If you mean whether I am personally investing certain money into a certain systematic trading system, then the answer is yes. What is the most important source of information algorithms should take into consideration while making trade decisions? Only price? No, not only price. And we consider 4 very fundamental domains that serve as sources for our trading decisions, for the design of the trading strategies. Can you name a few of the trading approaches that are covered? If you want to hear something about whether they are, I don't know, pairs trading, statistical arbitrage, and so on, then no, all the strategies that we consider are directional trading strategies, and even can be um, attributed to just a very few classes of strategies like mean reversion or setup trading or sometimes even breakout. The peculiarity of these systems and the peculiarity of this approach is not in a certain degree of sophistication in the way you enter or exit the markets. The edge is in the proper analysis of the market that you're going to trade, and therefore the appropriate timing of your trades, if you want. In your opinion, how much capital would a beginning independent systematic trader need to operate successfully and overcome commissions, margin costs? It depends on, well, basically it depends on what you're going to pursue in life and which market you're going to trade. Because, for example, you can start with a Forex bucket shop that offers you an MT4 platform with accounts as low as $1,000. And it's interesting that, yes, it is possible to trade such a small account given the proper money management, given the proper sizing. Modern Forex bucket shops allow you so-called micro lots, if I'm not mistaken, just $1,000 per contract, so you can very successfully trade them. It's another story that nevertheless the normal, reasonable annual return is somewhere between 30 and let's say 100%. Why are these figures so different? Basically, it depends on your risk appetite. So if you're willing to go for larger risk, you can make as much as 100% a year, in good case. If you are more conservative, let's say 20-30%. But if you start with $1,000, then the estimated return is $200 to $1,000 a year. I'm not sure if this is actually what you are looking for. Therefore, you only should be reasonable with the choice of your account size, simply to understand what you are going to achieve. Normally, a series account that allows you to trade, to diversify your trades, to trade different markets and therefore different strategies, and as a consequence, to diversify your risks, start with 50,000, approximately, better 50 or 100,000. Do you work with clients in all time zones? Any clients from Germany? Yes, presently I'm working with two guys from Germany and from Holland, so no problem. How much time commitment weekly will the course require? Again, hard to say, because it depends on your abilities to move on with learning new things. Live classes normally take 1.5 hours to 2 hours each, and between the classes, well, if just looking on the average time my students spend on that, I would say 1-2 hours a day, perhaps. Any more questions? How long are you invested in the market with one trade? Well, let me first correct you a little bit. There is investment and there are trades, and there are different things. An investment is something that you basically buy and forget. And you buy not because of certain special market conditions, or just because you think that this asset will increase its price on a very long time horizon. If we talk about trades, then we never invest into a trade. We just place a trade. Either we buy something for money or we just exchange one currency to another. So what you are referring to is simply the holding time, the average holding time of trade. Again, it depends on the system. There are systems that work intraday, and there are systems that hold positions for days, sometimes even for weeks. I even anticipate a question about larger risks that are associated with strategies that hold positions for weeks, but in fact, if you just give it a proper thought just once, you will immediately understand that these are separate things, risks and the holding period, because if your system is able to correctly, well, statistically significantly provide you with a positive mathematical expectancy for long-term trades, then the system will outperform any intraday system simply because of the smaller number of trades, less commissions, and so on. So it's not, this is not correct that longer holding periods assume larger risks. The key to success is always the understanding why you may want to stay in this position for a longer time. And this understanding comes only with the proper market analysis, the very foundation of the whole method that we start with in the course. Any more questions? Okay, I can see only thank you. So I believe there are no more questions, and let me also say thank you for visiting today's webinar. I hope it was interesting for you, at least judging on the amount and quality of your questions. So I humbly believe that it was. So again, thank you very much for your attention. In case you need any further information about our educational programs, about systematic trading and so on, please feel free to write an email to info@adepts.com. Be absolutely sure to visit our YouTube channel at youtube.com/ATSSN. And of course, be sure to subscribe to our future webinars, which you can find at ATSSN.com. The webinars are normally out on Wednesdays. One Wednesday is the first webinar at 5 p.m. New York time, and next Wednesday, as today, there is a repetition of the same webinar at 7 a.m. New York time for our European audience. So, again, thank you very much for your attention. Have a great day, have a great rest of the week, and see you again.